the numbers are out. Our March release of Consumer Price Index expected up 0.2% is up 0.1%. High watermark was 1.3. That was in June of 22, the highest since '05. And since then, the lowest has been 0. That was July of last year. If you look at ex-food and energy, expected up 0.4, exactly up 0.4. High water mark, April of 21, up 0.8, highest since '81. Since then, the low has been up 0.2 in August of 21. The biggies now. 5% year over year. That was expected to be 5.1, and the rearview mirror still is 6%. And every single month, as I said, since June when it peaked at 9.1, July, August, September, October, November, December, January, February, now March, have been lower.
Hey there, YouTube family. Welcome to the Stocks with Josh show. We've got a lot to cover today. I'm going to review the CPI report that came out. I'm going to review the market's reaction to it. I'm going to go over what I see right now in the S&P 500. I think the charts are communicating, and I've laid out a couple charts to review with you guys. I think it's going to give you a clear picture of what we're looking for, what we want to see happen to either confirm a bullish or bearish direction. We're looking for some confirmation. I think the charts are telling a story. I'm going to unwind that for you guys today. In addition, I'm going to give you guys some of the bigger plays that I'm in and some of the bigger positions that I took. I'm going to be covering those stocks. Some are some big tech, some are some long-term investments. I'm going to be covering those at the very end. So thank you guys for joining me. Thank you for hitting the like, hit the subscribe and the YouTube bell notifications to get daily stock and crypto insights from this channel as well as technical analysis. To keep the CPI inflation report simple, everything really came in according to expectation. Month over month, year over year, and core all came in line with expectation. It was, for all respect and purposes, a very, very positive sign that inflation is not raging out of control, but actually cooling off exactly as the Fed wants. 40 economists that were interviewed by Bloomberg were actually expecting not to hit expectations, but to see a rise in inflation. So this was actually a huge upset. It was a huge positive news story that inflation was getting tamed. So why did the markets sell off? With all that positive news, the fact is that inflation is still far away from the 2%, even though it's trending down. And the bottom line is that the rate increases are designed to accelerate the trend. The trend is going lower, but the rate increases are designed to accelerate the trend. As the rate hike indicator shows, there is a greater than 70% chance that the Fed will go forward with a 25 basis point rate hike to continue to accelerate inflation going down. Now, we've had some early leaks of the GDP report, and people are expecting that the GDP report is not going to come out negative. They're actually expecting a positive number. All of this is relatively good news. It means that the economy is not weak and inflation is coming down, but it appears that the Fed is going to use this as an opportunity, because things are actually going pretty well, to continue his rate hikes. The question is, how far? Right now, the market clearly believes he's going to move forward with a 25 basis point rate hike. Some could argue that the sell-off was because the good news in the economy was suggesting that the Fed had the room to continue to raise rates, even though there is a banking crisis that is essentially looming over our heads. The news was good enough for the Fed to continue to accelerate inflation going down by continuing to raise his rates. There may have been some in the market that were pricing in no rate hike, and that's why the sell-off occurred. But the fact that the market actually sold off on potentially good news, the fact that we might have a positive GDP and we've got inflation coming down and the Fed can continue to raise rates and potentially address inflation, is because we are dealing with profit taking. I gave everybody a sneak peek when I did my Sunday video. I gave you all the picture of those Venus flytraps capturing the flies, and I told you guys, instead of the flies, imagine the bulls are going to get trapped. We are at the top of the range on a lot of our favorite stocks, especially big tech, which has run up. And what we saw today is that the larger investors were selling into good news, which which let me explain it to you this way. If you've got 100 shares or even 1,000 shares of a big tech stock, you actually have a very small position to unwind, and there's enough liquidity for you to unwind it. But the bigger houses look to take profits on days where volume is essentially potentially going to spike up. And I think that's what we saw today. The bigger investment companies were selling into the potential good news that we got with the fact that inflation is coming down. And so we saw profit taking. Now, does this mean that all of these big tech companies are going to crash from this point forward and that the SPX is going to continue to trend down? I will cover my view on that in the charts in just a minute, but I'll also just answer you right now. The answer is no. What will happen is that these larger sellers will trigger a sell-off. Will be followed typically by retail that'll get fearful and they'll sell out. It'll trigger a bunch of stop losses, and so it creates this cascade. And when it goes from being overbought and pulling back and being slightly oversold, maybe on a lower time frame chart like the 4-hour, the 6-hour, or the 8-hour, then they'll pile back in. But when they pile back in, they won't pile back in with the same position size that they had entered before. And what that looks like is decreasing volume on the S&P 500. It means that the stock could continue to rise, but it's rising on a smaller volume base. Right now, on a good news day, this was a great time to sell your largest position, and then you can go in with a smaller position with a more risk-off approach to ride up the final wave of some of these big tech stocks. That was the story that I told to you guys on my Sunday video, which means that there absolutely is room in this sell-off for an additional rise up. And I was looking at big tech, and some were performing better than others. Microsoft was actually performing quite well today. And it's one of those big tech companies that I think there was some profit taking on, but it might indicate that it's going to be one of the companies that rebounds faster. I'm also going to let you know which big tech I got back into today so that you guys can follow me along. Let me take a quick station break. If you need better trade tools, there's a great offer from the moomoo investment app. They're offering up to 15 free stock for opening and funding an account, as well as a cash coupon of up to $1,500. Cash coupon appears within your account and you can immediately begin to use it to invest. So they're offering up to $1,500 as a cash coupon. You can also get a 1-month subscription to Benzinga Pro, which will help you guys get your option game going with more consistency. But when you get all of that done, the best thing about moomoo is the chat group that I host on the app called Stock Josh Fam. If you're part of that chat group and you like it, please throw a heart in the comment section. But let's just take a quick minute and go over the S&P 500 charts. So we've got this old defending trend line that was established in all of 2022, which eventually, when it came down and it retested the 3,800 level and bounced, we began to move out of that downward trend line and we entered into a new trend line, which we can see began on October. And if you follow that one forward, it gives you the picture of essentially 2 price points. We have the potential of this move dying off where it's currently at, under 4,100, and possibly pulling back to an old level of support at 3,950. Or we have to ask ourselves, are we going to push through on volume and momentum and push all the way back up to the top of this trend line, which would be closer to around the 4,400 area. Now, I want to point out a really interesting tweet that I think sums up a lot of what's going on, and it sets a great tone for all of us to have perspective on where the market's at right now. It's what the Fed's rate was in 2022 versus 2023. And how it correlated to the S&P 500. So May 6, 2022, the Fed funds rate was under 1% at 0.83, okay? And at that time, the S&P 500 was 4,123. Now, it's really shocking because if we stop and analyze where we're at today, we are April 12, 2023. The Fed's fund rate is 4.83%. And we're around that same range of 4,123. And so it really, really doesn't make sense for us to be up at this level. And all of that with lower corporate earnings. And so that brings me to another big point that I wanted to make. We're going to see some final action and some final moves up and down when we begin to go through the earnings, which are right around the corner. Point out that the signal line on the MACD indicator might be curling over as price is flattening out. These are momentum indicators, and on the S&P 500, the charts are clearly telling us that the momentum to the upside is definitely cooling off, which goes back to my explanation that the bigger investors are selling into this bear rally and then re-entering it with lower position size, causing it to go up higher, but on lower overall volume. And eventually, the selling is going to accelerate and people are going to get trapped up at the very top. I also want to point out to you guys that we have back tested the 4,100 range from that long downward trend in 2022, and we have yet to close above it. We are consistently on the weekly candlestick chart, we're consistently closing below it. Matter of fact, 6 times and 6 candlesticks, we have failed to break over the 4,100 level. And so what that might indicate is, again, that when we get to those elevated levels, that's a distribution level, and that's where larger companies, larger investment groups are selling their bags. The question is, who's buying them? Keeping it very simple. For me to change and for me to shift into the idea that we could actually go up from here and that the worst is behind us, technically, we need a simple green candlestick close on the weekly chart above 4,100, which you clearly see that we have not gotten all this year. And what that leads me into is believing that we are going to see some big tech continue to fall in the days ahead, which means that I'm looking at the sqqq. Now, I have a personal desire to load up more in the $28 range, so I'm hoping that we move up a little bit more so I can realize that price entry. I also have been accumulating the VIX, VIX. There are alternatives to the VIX, like the UVXY, the VXX. I personally have found more consistent trading in the VIX, but it's not available on every platform. But what I'm doing is I'm trading volatility, which has come down. I also like the VIX anytime it's around the $18 mark. I have an options position, and I will be adding to it for the next couple days as the market is vacillating in this range above 4,100, because I believe that volatility is going to skyrocket. And I think that if we continue to face the fact that we cannot break above 4,100, I think we're going to begin to go back and test some level of low, which I will let you guys know when I have a better handle on exactly what that would be. At bare minimum, it would be that 39.50 that we should see right away. I get asked a lot in the chat group about Alibaba. Josh, it dropped, it had a nice pullback today. And the question is, was it an opportunity to buy, or, are you trapped up at $99 if you happen to get in with no stop loss, or up at $100? My belief on Alibaba is that it absolutely is in a long-term trend up. When I got into this at $79 and $80 and $81, I intended to hold all the way to 120 as a bare minimum. Baba is a long-term play. I've got high conviction, and I believe that it's going to go up to $120 bare minimum. And then after that, it could go as high as 160 or 180 as we get further into next year. In addition, today was an opportunity for me to add Tesla calls. I am bullish on the chart of Tesla. When I gave you my review of the big tech companies, Microsoft, NVIDIA, Apple, and Tesla, I told you that NVIDIA, Microsoft, and Apple all had sell signals, while Tesla was still operating under a buy signal, which means that they've got bullish momentum. Now, I'm in on some call options at 180. I bought more on the pullback, and I believe that there's opportunity to the upside on Tesla. I don't think the market is fully ready to flash down. I think this was just a profit-taking moment. I think it's going to be a reset moment, and I think it's going to then continue to trend higher. But it's going to continue to trend higher on lower volume, getting ready to be set up for a potential move down unless we get that weekly candlestick close above 4,100, which we have yet to get. This is not an easy money environment. I just want to repeat that. This is not an easy money environment. It means that there is potentially a lot of room to the downside. We're not in a long-term trend up, so we can only focus on trades that we have high conviction for. One of them is Alibaba, one of them is GEHC, one of them is Perion Network, as well as the fact that I have a mid-level of conviction on Tesla, enough to buy some call options. I'm not right now heavily into the stock. And I definitely am sending out the warning that the market is at the top of the range, big tech's at the top of the range, and I don't want you guys to get stuck either without stop losses or buying at the top of the range when there's a lot more room down. That pretty much wraps us up for today. I have some other videos that I'm looking forward to sharing with you guys this week. Thank you for hitting the like, hit the subscribe, and the YouTube all notification bell to continue to be part of this investment conversation. Take care. Peace and blessings, my friends. See you in the chat.